Hey, what's up, guys? John here. I think money lenders are about to make a ton of money. And why would I think that in a credit card bubble? This huge bubble that's about to pop and all of this pain that's going to happen on the economy. Well, because I think that there's two different types of lenders, one of which is going to get greatly impacted and another of which is going to profit immensely. Now, we're in this inflationary environment. This inflationary environment is eroding the purchasing power of a dollar. We're also seeing higher gas prices and we're seeing more uncertainty. We're seeing this coupled with increasing interest rates, and as that happens, it gets more expensive to borrow money and to service existing debt, making it more challenging for business owners to expand their businesses and pushing employees to a place in which they need to make more money to keep up with inflation and to pay off their increasing balances on their credit cards, because these credit card balances are getting more expensive as interest rates rise. So we're going to start to see more people taking second and third and fourth jobs as they are forced to make good with these debt commitments. Take a look at what's happening right now. The credit card debt chart on Fred has really just started skyrocketing more and more and more. And there's other industries right now that are seeing a huge boom. Pawn shops, for instance, are seeing a boom in business amid inflation, right? It's not just pawn shops. We're going to see payday lenders do extremely well, installment lenders doing very well. We're going to see collateralized lenders doing well, even car title loan lenders. All of these investors, people, hard money lenders are going to do very well. Construction loans are going to do well. Bridge loans. All of the people controlling the capital in these uncertain times are going to do well. Now, what I would suggest doing is if you are going to be issuing any type of loan on an asset, whether it be a vehicle or a property or even a watch, if you're going to lend on this, is to really be a conservative lender, because we could see a situation in which rates rise faster than people anticipate and we see a pullback in this economy at a greater scale than most are prepared for. And so what you want to do is you want to remove as much risk from the equation as possible. But I'm hearing stories, recently I was at a children's event with my young son and I was talking to another father at the event, and he was telling me that they're working with private equity companies at his pawn shop. And this pawn shop, they're taking, let's say, $1 million, and the overall return to the private equity company is about 80%. So they'll invest $1 million and pull 1.8 out. This is the type of industries that are going to be doing very, very well. Now, there's also going to be some that are going to do very poorly. Now, like some of these uncollateralized lenders, some of these credit card companies, and some of these other lenders are going to suffer some losses, maybe increased losses greater than what they anticipated, such as payday lenders and installment lenders. But the loans in which they are lending, they're much smaller. Payday loans, the average loan is probably $350, right? And so it's not a huge loan. And so they're probably going to increase the level in which they're going to take risk off the table by being a more conservative lender. But we're going to see these lenders and these companies do extremely well, right? And so when we're in this credit card bubble, like what we're in right now, we're seeing even credit card companies, their interest rates are starting to surge record levels for new cards, right? And why are they doing that? Well, they need to make more money because they have immense risk. Right? They're going to have more risk, so they really need to pull money in. We're kind of seeing that with landlords right now across the country. California and New York, for example, they have record high vacancies and tenants not able to pay. And so I think that they are increasing rents based on the fact that they are assuming losses in other units. I think the same thing is going to be very true here with credit cards and non-collateralized loans, right? Things are going to get more expensive. Now with payday loans and installment loans, they can only increase interest rates to a certain extent. And they're not able to just increase rates to whatever loan that they would like to lend on. It just doesn't work like that. Every state has their own laws and guidelines in which they need to operate inside of, or they could really walk into a lot of trouble. Americans lose confidence in paying credit card bills. Inflation's eating away at America's financial security. The share of Americans who weren't confident they could pay the credit card balance in full hit its lowest point since 2018, according to LendingTree's survey. Just 53% of cardholders said that they were confident that they could pay their credit card's monthly balance in full this month, down 10 points in May and matching the largest monthly decline in nearly 4-year history in confidence index. The drop in confidence across all demographics and ages, the surveys found showing the Americans nationwide are feeling the pinch from inflation. There's only so long that a credit card holder can be expected to manage rampant inflation, rising interest rates, spreading increased spending, and general overall economic uncertainty before they start to struggle a little bit more. In the past few months, with how quickly gas prices have risen and how grocery bills have grown, there are only two things that hit almost everybody when those sort of basic fundamental costs of life. It ends up taking a big toll. The Federal Reserve this month hiked a benchmark interest rate. They're set to do that again in about 10 days or less, about a week. So they're set to increase interest rates again. So as that begins to happen, I really believe we're just going to see more and more of this. And I think we are going to see this credit card bubble blow up, and it's going to get bad. It's going to get bad. And that's why I also think it's so important now people pay attention to their credit score and how they spend money, where they spend money, reduce the expenses if at all possible. Bring those costs down as much as possible so that you have the additional capital, liquidity, and you have the ability to pivot and move with the times. The largest increase since 1994, in less than a month, the rate on credit cards will follow suit, and the central bank is not done hiking rate signaling plans to increase rates by another 1.75 percentage points over the next 4 remaining meetings this year. It's especially worrying since Americans have continued to rack up their credit cards, which jumped to $1.03 trillion in April. The number now is almost $1.15 trillion. So the numbers have jumped dramatically in just the last 3 months. Credit card debt can now be a sign of trouble. Of course it's going to be a sign of trouble for people who are using credit cards to make ends meet, because if they're buying items at 10, 20, 30% more than what they were accustomed to paying before, and now they are buying them based on a 28% interest rate, and they are making the minimum payments, they're going to spend $5,000 and pay back $15,000 or $18,000. Right? You pay back 2.5 to 3 times what you borrow if you pay minimum payments. So that is definitely a sign in which a consumer is struggling. I don't think there's any question that we're seeing both these things happen simultaneously. Right now, it's just a matter of determining which of those factors is driving more, right? And so right now, short-term confidence at 53%, it's the lowest that it's been, tied with September 2019. Only 2 other times since the short-term confidence fallen below 60%, 10-point monthly decrease in short-term confidence. This equals the biggest decline on record, matched only by November of 2020's drop amid the chaos of right? And long-term confidence falls 39%. Fewer than 4 in 10 cardholders expect to pay their credit card's monthly statement balances in full 5 or more times in the next 6 months. Our measure of long-term confidence, November 2019, is the only other month where long-term confidence dipped below 40%. 11-point monthly decrease in long-term confidence. This is the biggest monthly drop since the index began, right? So although odds dipped, LendingTree survey finds 70% of requests for lower credit card APRs are still getting granted. That's why, I personally think this is a great time to start getting qualified for new lending partners, whether it's American Express or whoever it may be. Get as much credit as you possibly can. I'm not saying to utilize it. I'm not saying to spend it, but get access to all of these credit lines. Because if you can get access to all these credit lines, it just gives you more options, more opportunity. And ideally, credit lines in which offer you 0% APR for 6 months or 12 months, just to have them. You can spend small on these cards, pay them off, just to start building out all these relationships. I think we're going to step into a scenario in which we're going to see a lot of tightening of lending. And so the more options you have, the better. If you need help fixing your credit, you want to have your credit score fixed, my team is absolutely amazing at cashnow.video. That's cashnow.video. If you want to make money on YouTube, start an online business, cashnow.video. And if you want to invest in real estate when the market crashes, cashnow.video. I'll catch you guys in the next one. Subscribe here. Also subscribe on my second channel. It's going to be an interactive call-in show starting this upcoming week. I'm really looking forward to it. And LinkedIn, Twitter, Instagram, and TikTok up in the banner. And I'll catch you guys in the next video. If you're interested in being sponsored on my YouTube channel, visit cashnow.video/sponsor and fill out the application.